Hello, everyone, and welcome to the Market Outlook for 2025. We're glad you're here. We're looking forward to spending the next hour or so recapping what we experienced in 2024 and looking ahead to this year and beyond. We'll wrap up today's presentation with a session on where to focus next. Throughout this presentation, we plan on covering lots of material and charts. It's important to remember that this information isn't specific advice or a recommendation of any kind. If you have questions that are specific to your portfolio or financial plan, I encourage you to reach out directly to your advisory team and schedule a time to speak with them directly. How many of you recognize these logos? These companies are often referred to as the experts we see sharing their thoughts and predictions about what the market or economy is or isn't going to do. But how often are they right? How many of you think they got it right for 2024? Let's take a look. Interesting. We've got some mixed results from these experts on what 2024 should have been. But the real question remains, was anyone actually close? Not a single one. Not a single expert correctly predicted what the market was going to do in 2024. This is another great reminder that trying to predict what the market's going to do in any given period of time is almost impossible and usually comes down to just being lucky. So today, we're going to cover lots of material, none of which is a prediction of any kind. We're simply evaluating where we're at and what might lie ahead for the market and the economy. So, with that said, let's continue our recap of 2024. Now, despite those expert predictions, 2024 was another great year for the US stock market, up 25%. I really like this chart because it categorizes calendar year returns for the US stock market going back to 1926. You can see the different levels grouped by various points of return, with bear markets years highlighted in dark red and years where you lose money slightly to the right of that. And then probably most interesting is right there in the middle. The average return for stocks is around 10.4% historically, but rarely do stocks finish around their average. When we look at the 8 to 12% range, we only had 6 calendar years going back to 1926. So in almost 100 years of data, only 6 years finished right around their average. The fact that stocks rarely finish around their average is probably somewhat surprising. But let's take a look at that green column. This is probably the most compelling thing about this slide. We've had 38 great years. So by far, the biggest column is years which the stock market's up more than 20% in a calendar year. And I think that's extremely compelling. That's the thing about being an investor, right? You just need to be invested for those great years and be able to stick around and weather some of the storms on the far left of the page. That's really the key to building wealth, by being a disciplined investor over a long period of time. But I know this group already knows that. Now in 2024, we saw large cap stocks once again lead the way. The S&P 500 finished 2024 up 25%. When we take a closer look, we see that large cap growth stocks were up again 35%, and the Magnificent Seven stocks finished up 67%. We talked a lot about the Magnificent Seven at our mid-year market outlook, and as we expected, the Mag 7 did play less of a role in the S&P 500 returns for 2024. Now, unfortunately, we saw international stocks continue to underperform, as did small caps, despite making a big run in the second half of the year, really through November. Many of you probably recall the volatility we experienced in December, and while growth stocks held up okay during that December pullback, we saw the risk of small caps really being highlighted and pulling back over 8%, essentially erasing a good portion of their year-to-date gains. As we look forward, we still have lots of faith in the stock market, particularly the US large cap portion. We've continued to be strategic with our small cap allocation and feel good about that decision, particularly with the Fed projected to keep interest rates higher for longer. So what about those well-diversified portfolios? The 60/40 is of course trailing the US stock market, which is natural and to be expected. The gap between the diversified portfolio and the S&P 500 is pretty wide over the last couple years, and I think that can cause some frustration, especially when the media outlets continue to reference the S&P 500 as the market. And even though there have been some really good years for the diversified portfolio, double-digit returns in many cases, the fact that you could have had a lot more money if you just owned US stocks can be frustrating. I think it's important to understand that and recognize that that's okay. On the right-hand side of this slide, you can see the gap between the S&P 500 and the 60/40 portfolio. You can see that this is not something that's uncommon. In fact, 2021 was even bigger than what we saw in 2024. As you all know, having a well-constructed financial plan is the foundation of what we do, and we let that ultimately determine the level of risk you need to take in order to accomplish your goals. At the end of the day, it's really more about finding a balance between risk and reward. Switching gears to the bond side, we've laid out the slide in the same pattern that we looked at for stocks. But as you can see, the pattern here is very different. We have the one bear market year for bonds down over 13% in 2022, which is a great reminder of just how difficult this year was and how historically rare it was as well. This year, we were up 1.3% for the core bond index, and bonds gave up a lot in those last few months of 2024, especially as interest rates drifted higher. What we can see on this chart is it is very normal for bonds to be right in the middle, anywhere between 0 and 7%. That's where 59 out of the last 99 years sit, right in the middle. And that's one reason why bonds inside of a portfolio make a nice balance or ballast. They provide a level of predictability or a level of return that's a little more stable than what we saw on the stock side, where we saw a little bit more at the extremes on both sides of that chart. I think this is a great way for us to compare stocks and bonds and ultimately understand why bonds work well traditionally inside of a portfolio. Now in 2024, we finally saw the yield curve disinvert as the Fed lowered the Fed funds rate. We also saw the longer-term bond yields rise following the Fed's first rate cut in September. While it's certainly not normal for longer-term yields to rise in this scenario, it does potentially set up for a better 2025 for bonds. We also saw bonds with much longer durations impacted the greatest, although the higher yields protected most categories from losing money on a total return basis. While we did extend our duration slightly from our baseline, we continue to be underweight long-duration fixed income options. Instead, we prefer exposure to the short to intermediate part of the curve. We saw credit spreads tighten a little through the year, which helped boost higher yielding asset classes even further. And looking ahead, we're comfortable with where today's spread levels are and believe that higher yields could help provide balance against market volatility, which we'll certainly talk about in a little bit. I think it's also important to highlight the fact that real yields on bonds are at the highest that we've seen since 2015, almost 10 years. Now, real yields are inflation adjusted, so just taking the yield on the 10-year US Treasury, adjusting for inflation, we're currently over 1.5%. And that's a pretty nice territory for bonds and fixed income going forward. You can see on the right-hand side of this chart, whenever you've invested in bonds and they've had a real yield, real positive yield, you average 8.1% in the preceding 12 months. And on the other side of that, if you invest when they've had a negative yield, which is really where we've been the last 3 years or so, your returns tend to look very flat. And we've seen that as a result as well. So as we often say, past performance is no guarantee of future results, but this does bode well for bonds moving forward. We've reset interest rates to a healthy level. The fact that real yields are positive, history tells us that that's a good time to put money to work into bonds and fixed income in general. Now, we can't forget to talk about the economy. From an economic perspective, we saw inflation continue to reduce and labor markets normalize, which allowed the Federal Reserve to start lowering rates in September. Now, this was something we pointed out at our mid-year outlook and felt strongly that we'd see from the Fed in the fall. And while we saw significant improvements in these numbers, we're certainly not out of the woods just yet. Inflation as a whole still remains a risk for the overall economy. Something we'll talk about surrounding 2025 is the impact of proposed policy changes such as an immigration restriction and tariffs, both of which could have significant impact to inflation moving forward. Growth also stayed resilient throughout 2024, which played a significant role in keeping the U.S. well out of recession territory. We continue to remain optimistic when it comes to the U.S., and we expect economic growth to continue, largely supported by a strong consumer spending and the potential of new tax cuts. Finally, I think it's important to review what economic cycles look like in general, just from an expansion and recession standpoint. We had one of the shortest recessions on record, the pandemic recession, in March and April of 2020. And you could see how rare that was. Only 2 months long, very severe, but very short. And you can see now the recovery. We're currently about 57 months into a recovery. And when we look at the average recovery going back to 1926, it's about 61 months. So we're getting pretty close to that historical average. What's more interesting is when you look at the bottom left-hand corner of this slide. Since the early 1980s, the average expansion has actually lasted closer to 100 months, which I think shows how the economy has evolved a bit. We're more of a service economy today than we've been in the past, so we don't tend to have some of those extreme economic cycles that we had when we were more of a manufacturing economy, more of that boom and bust cycle. I think this chart and the data in this chart illustrate that we may have more room left in this economic expansion. So here's a quick highlight just of some of the things that we saw from 2024. And despite so much uncertainty from the US election, shifting monetary policy, and heightened geopolitical tensions, we just heard how impressive 2024 proved to be for both the economy and financial markets. That said, the outlook for 2025 is largely uncertain. Policies proposed by the incoming administration, should they provide any inflationary impulse, could result in a more gradual pace of policy easing or an early end to the rate cutting cycle altogether. So let's start off by taking a look at what we might expect from the economy in 2025. We've already established that 2024 was another impressive year. We saw real GDP growing at an above-trend pace for a fourth consecutive year. Now, given that consumption accounts for almost 70% of the US economy, it's no surprise that the health of the economy is closely tied to that of the consumer. This is furthermore supported by impressive gains in household wealth, with 20 consecutive months of positive year-over-year real wage gains. There's no question, consumer spending has powered our economy forward. And despite the list of potential risks we still face, 2025 should be another year of expansion, likely at a trend-like pace. We've seen the labor market normalize now from its post-pandemic boom, and job growth has settled into a healthy pace. In 2023, Immigration Services approved over 2 million initial applications for employment authorization, a 70% increase from a record 1.2 million in 2022. That surge in the migrant population and workers meant that employers were able to fill open job roles without applying additional pressure to wages, which helps to explain why strong job creation didn't spark higher inflation. And this is certainly going to be something we're going to discuss when we talk about the risks that we still face. Now, with the continued aging of baby boomers into their retirement years, we are left with an overall labor force participation rate below pre-pandemic levels. However, when we zoom in, participation amongst prime age workers has fully recovered from its pandemic losses, and it's been particularly strong amongst women. It's also important to note that we saw the unemployment rate rise in the first half of 2024, but has since stabilized towards the end of 2024. At 4.2% in November, unemployment is above its cycle low of 3.4% set in April of 2023. But with that said, unemployment is still lower than it's been in almost 88% of the time over the last 50 years. Inflation has continued to make meaningful progress towards 2%, allowing the Fed to start its rate cutting cycle. While that downward momentum slowed in the latter part of 2024, there's little evidence to suggest that price pressures are building. Absent any policy shocks, inflation should continue its downward trend in 2025, especially as shelter and auto insurance prices normalize. The return to 2% is significant and directly impacts the consumer. And we just heard how important the consumer is to moving our economy forward. The 2% number is actually more in line with the average wage increase year over year. Since 2021, prices have risen 2% more than the average earnings growth, which is actually an improvement from where we were just a year ago. The hope is that we see this gap continue to close over the course of this year and into 2026. It's also important to note that when we build out your long-term financial plans, we're building in inflation adjustments based off of the 30-year historical average, which right now is sitting around 2.68%, so slightly higher than the target of 2% that the Fed is looking for. With inflation trending lower and the labor market softening, the Federal Reserve cut interest rates by 100 basis points in 2024. In 2025, we believe the committee will certainly have a preference to continue easing policy until they ultimately reach a neutral stance. However, potential fiscal stimulus in addition to tariff and immigration policies could make this difficult to achieve. With strong economic activity and increased inflation uncertainty, the committee has penciled in just 2 rate cuts for 2025 versus the initial 4 we saw in September. This is something we'll be continually monitoring closely as we move throughout the year. It's also important to remember that price change and inflation change are not the same thing. While the Fed has certainly done a good job with the soft landing, we as consumers haven't exactly seen or felt that in our wallets. This is because the Fed is not changing the price of goods, they're simply slowing the pace in which the price of those goods will increase moving forward. Both presidential candidates made promises along the campaign trail to restore prices back to pre-pandemic levels. And unfortunately, this just isn't possible. Doing so would require any and all wage growth during that period to be stripped away. Any new jobs created would need to be eliminated, and so on and so on. This isn't something that's going to happen, and it's important as a consumer that you realize and understand that. I think today we're seeing a market expectation a little bit more aggressive than that of the Fed's forecast. I think this really highlights the fear that inflationary policies proposed might force the Fed to consider a slower pace or a pause altogether. Now, we agree that a more gradual policy easing path is the most likely outcome, but until we gain more clarity on President Trump's agenda, the pace of rate cuts will continue to hinge on the incoming economic data. So, what does this all mean for the stock market in 2025? Well, we've been up 25% or more the last 2 calendar years, which is not only impressive, it's also historically rare. You can see on the right-hand side, this is only the 5th time that that's happened going back to 1926. We had a few in the Great Depression era, so 1927 and 28, and then again in 1935 and 36. More recently, 1997 and 1998 were greater than 25%, and then 1999 we were up over 21%. So what does that mean for 2025, if anything? Well, stocks certainly aren't cheap, but we still have a lot of confidence in stocks at this point. We think a lot of the fundamentals still support this case, and we also think that maybe history looks a little bit like what we saw in the 50s or even more recently in the 90s, where stocks still have room to continue with their momentum. But the real question, the burning question, can it last? Let's take a look at bull market length. And I think this is one of the most convincing cases for where we are in the cycle. If you look at a bull market, the length versus average, normally bull markets average about 55 months. That's the median going back to 1926. We can also see that the average return during this time is about 200%. Currently, we're only about 26 months in and up about 74% in this cycle. So it's still pretty young versus the historical average, which makes a strong case for why this bull market may have more room to go. Another great indicator for US stocks is what's happening with flows into mutual funds and exchange traded funds. As we know, the market finished up great in 2024, yet flows into mutual funds and exchange traded funds was pretty modest. 2023 was actually slightly negative. You can see from this chart where that ranks historically. We're nowhere close to what we saw in 2021 or some of the best years since 1993. What's interesting, when you get some of your best inflowing years, it's actually when stocks do their worst in the next calendar year, averaging just 1.6%. And you can see that if you invest following some of the worst outflowing years, like we saw in 2020 as a great example, we all know what stocks did in 2021. They had a big year. In fact, you average almost 24% following any of those worst 10 calendar years. So 2024 would qualify really right in the middle, which I think is some additional optimistic news. It shows us that the sentiment in the retail market, maybe the nice way of saying the do-it-yourselfers, they're not chasing this bull market in an enormous way. It's certainly modest, but nothing that's overboard like we've seen in the past. Although we've seen smaller cap stocks rally on some of the optimism around proposed policy changes with this new administration, we still remain somewhat skeptical given the expensive valuation and lower profit margins of this particular asset class. Now, this certainly doesn't mean that we're abandoning the small cap space, but it does support our position around the large cap portion of the portfolios. And we do feel that the large cap in general will continue the domination that they've had over the last few years. And the US outperformance that we've become so used to is likely to continue, which is something that's also reflected in our portfolio allocations as we move into 2025. We believe that the high valuations and the concentration to tech stocks within the US make having international exposure a prudent decision. So again, we have not abandoned our exposure to international, but we do expect the US growth to keep outpacing the rest of the world. Although the international stock market still has plenty of room to surprise us on the upside if they want to join the party. So let's not forget about the bond side of investing. Interest rates finished higher than they started the year in 2024, with most of that happening as rate cut expectations changed from the Fed. Despite this, bonds still produced positive returns as price declines were more than offset by income received. I thought this was a good opportunity to just refresh everyone on what bond math looks like. Your total return from a bond is really made up of two components: the income you receive, which is also known as the yield, and the change in price. So the illustration below, we see that we experienced in 2024 when we look at the US aggregate bond index. We see that even though we had a negative change in price, the income received kept the total return positive for the year. Now, higher level of current yields can help continue to provide a cushion for bonds should rates continue to increase moving forward. The chart at the very bottom shows the impact of flat or decreased rates. We think that this makes for a very strong bond outlook in 2025. As you can see from the chart, if rates remain unchanged, the total return for the US aggregate bond is projected to be 4.9%. And with just a 0.5% decrease in rates, you can see that quickly jumps to 8%. This definitely leaves us feeling strong about what 2025 might look like for the bond market in general. Now, widening spreads shouldn't be an issue either. The current economic backdrop and broadening earnings growth should keep them relatively tight. With the Fed likely to ease policy only gradually, it's difficult to make any bets on the duration side for right now. As a firm, we've not made any changes to our duration outlook within our portfolios at this time. If we zoom out some, you can also see going back to October of 2022, the 10-year US Treasury reset to over 4%. And you can see how we've been in a trading range, really between 3.2% back in April of 2023 to 5% in October of 2023. We've essentially just bounced around right in between for the last few years. If you look closely, rates really haven't gone far at all. They've gone a little bit higher since October of 22, but not significantly. I think what this chart really highlights is the dramatic swings that we've experienced in such short periods of time. And that's where the chart on the right comes in. On the right, you can see different fixed income categories, and we've seen how active managers have been able to provide a little bit more return when it comes to the bond portion of portfolios. They've been able to navigate some of those dramatic swings in rates, and that added ability to make changes as needed has helped bond managers adjust when these changes come quickly. We think this will be important as we move forward, especially with all the uncertainty around potential policy changes. And last, bonds still bring us diversification that is important to many portfolios and long-term financial plans. Core bonds can provide protection, especially in stressed markets. With all the hype and excitement around the stock market, it can be easy to forget the importance bonds actually play. While bonds have, in general, had a tough few years, they've historically done a great job providing protection when it really counts. You can see here what bonds have done in some of the toughest markets we've had over the last 25 years. So while there's lots of positives as we look at 2025, there's certainly some fog being casted over the general economic outlook for the year. The possibility of stronger restrictions on immigration, aggressive tariff policies, and the extension of the Tax Cuts and Jobs Act all have the ability to impact inflation. That's right. Here we are years later, and inflation is still the primary risk for the economy and financial markets. It is the shark in the water. While we have continued to trend in the right direction, some of the potential policy changes could have significant impact. In 25, steady economic growth should support continued job gains, reducing the risk of any further meaningful rise in unemployment, which should also stabilize wage growth as well. However, we know the Trump administration has expressed its intent to take a tougher stance on immigration, which could certainly have implications for the labor market in 2025 and beyond. Now, much of the uncertainty is around what this will ultimately look like. If the focus is primarily on immigrants with criminal records or those that pose a threat to national security, this may be a moot point. However, if immigration were to be significantly restricted, it could hinder labor force growth, especially in areas like agriculture, construction, and healthcare, and could potentially lead to higher inflation through higher wages. And we can't talk about risks without mentioning tariffs. Over time, economic globalization has led to increasingly relaxed trade policies. It's no secret, the average tariff rate on U.S. imports has steadily fallen since the 1930s. However, geopolitical tensions and supply chain issues induced by COVID have prompted a reevaluation of open trade policies. With promises to protect American businesses and address unfair trade practices, tariffs sit at the center of the Trump administration's policy agenda. Tariffs are a policy area where the president has a significant amount of unilateral control. The president has the power to make sweeping changes to tariffs without congressional approval, unlike many other policy areas such as changes to income tax rates. Now, if we assume a 20% universal tariff and an additional tariff of, say, 60% on Chinese imports, calculations by the Tax Foundation suggest the average tariff rate on U.S. imports could rise to 17.7% in 2025, up from 2.4% in 2023. It's still unclear whether they will be implemented permanently or used as a negotiation tool. Either way, tariffs are likely to rise under the incoming administration, with a particular focus on China. And beyond discouraging imports, tariffs can have negative unintended consequences. If we take Trump at his word, the rollout of these tariffs could impart a modest stagflation shock on the U.S. economy. Higher inflation, higher unemployment, and weaker growth are all potential outcomes in this scenario. Aggressive tariffs would add even more uncertainty to an already complicated economic outlook and would certainly throw a wrench in the Federal Reserve's path forward. Now, it's certainly possible and more probable that we'll see him implement much lower tariffs and in a more targeted manner than his original proposal. This is something we're keeping a close eye on as it can impact many different areas of our economy. This is also not something we are likely to see go into place right away, and it would anticipate this being implemented towards the back half of this year. We've also heard the Trump administration express their intent to fully extend the Tax Cuts and Jobs Act, or the TCJA, and reduce the corporate tax rate. They've also promised to dramatically cut costs. In this chart, we see the outlook from the deficit and federal debt. With no revenue or spending offsets, the TCJA is likely to amount to significant stimulus and add to deficits. It's also important to note that if the TCJA is not extended, most Americans will experience an increase to their tax bill at its expiration. It's estimated that a full extension of the TCJA would cost roughly $4.6 trillion over 10 years relative to current law. But it's also too soon to say what might happen. While we're fairly certain that the 2017 TCJA will be extended, it's still not clear if additional tax cuts will be added, and if so, how large those might be. Because the extension and any additional provisions still need to be passed through a once-a-year budget reconciliation process, they are unlikely to go into effect until early 2026. And every year, the federal deficit gets added to our overall debt. According to the CBO, federal debt is expected to climb to nearly 120% of GDP by 2034, excluding the impacts of TCJA, and nearly 130% with them. That figure is up from 98.2% in 2024. Which really brings us to a broader topic, spending. This chart shows estimates for government spending and how that spending will be financed in 2025. To reach its cost-cutting goals, the incoming administration may have to make some difficult decisions. Non-defense discretionary spending accounts for just 12% of the government's budget, meaning they may have to explore spending cuts on defense or entitlements. We've already discussed the administration's intent to use tariff revenues to offset the extension of the TCJA. However, tariffs are only a sliver of government revenue and will likely remain the case, even if Trump's tariff policies are implemented in full. This chart also shows the source of government revenue and how much the government must borrow to cover that spending. It shows that the net interest outlays are expected to grow rapidly and become a larger part of the deficit moving forward. This is certainly something that's going to be a continued issue that we'll need to watch, and I anticipate that there'll be many tough conversations in Washington as we move throughout the year and beyond. So here's a quick list of key takeaways as we look through 2025. And with all the positive news that we have for 2025, coupled with all the uncertainty that's still out there and lingering, where should you be focusing? How do you see through some of the noise or all of the noise that's in our face each and every day? This chart goes back to the early 1900s, and it represents the S&P 500. And in that time, we've seen wars, different administrations, natural disasters, financial market collapses, all types of interest rate environments, spikes to inflation, and even a global pandemic. Yet one thing's never changed, and that's the long-term growth that the market provides. Companies at their core are motivated and incentivized to grow, regardless of the environment they find themselves in. It's important to remember that this time might feel different, but it's nothing the market hasn't seen or navigated, at least in some capacity before. It's also important to remember that the market declines are normal. In fact, they happen almost every single year. This chart shows the intra-year S&P 500 declines, indicated by the red dot, as well as the full year return indicated by the gray bar. It shows us that double-digit intra-year declines are typical, and that more often than not, the market still finishes in positive territory. In fact, the average intra-year decline is 14.1%, and despite that decline, annual returns were positive 34 of the 45-year history shown here on this slide. This is another encouraging reason for staying the course when markets get volatile. It also illustrates the reward of being a disciplined investor and staying the course no matter what. And I know it's not always easy to see the benefits of staying the course, but when you zoom out from any 1 year period, it's pretty clear that being a disciplined investor and utilizing a well-balanced portfolio can have significant benefits. This chart shows the historical returns by holding period for stocks, bonds, and a 60/40 portfolio, rebalanced annually over different time periods. The bar shows the highest and lowest returns experienced during each time period: 1 year, 5-year rolling, 10-year rolling, and 20-year rolling. As you can see, when you move outside of that 1 year period, the data shows us that there are benefits for having a balanced portfolio and keeping it for a long time horizon. And there's no question, cash yields and safe alternatives have been at all-time highs. We've seen that in money markets, CDs, and treasuries. But at the end of the day, there's still no match long-term for a diversified, balanced portfolio. You can see from this chart that over time, the difference becomes staggering with those compounding returns, with a 60/40 portfolio outperforming cash 100% of the time in rolling 20-year periods. Having cash on hand can be an important part of each of your financial plans. And this chart just makes a strong case for why putting extra cash on hand may have long-term benefits. It's of course important to discuss this with your advisory team before making any type of decision. We've covered a lot of material today, and although it's important to know and be aware of, it's not something we can control or change. As I mentioned earlier, we focus on your financial plan first, and then make sure your portfolio is aligned to your life and your financial goals. You should focus on what you can control and what's happening in your life. Hopefully, that's planning the next big trip or adventure, welcoming a new family member, or celebrating a new milestone. We're your financial guides working for you to help make sure you can move forward with your life so you don't have to worry about the markets and the economy. Ignore Wall Street, ignore the financial news, and live your best life. Thank you again for giving us the opportunity to serve you and your family.